see. Let's see if everything's working. Please let me know. I would like to check as well how many people are here today. As I would like to continue on the Ghost Monetary Paradigm series. Let me see. Good morning. Oh, good. Miss Edike, good morning. All right, beautiful. Everything's working. So last time, we had some issues with the proxies. VPN, therefore. This week, a messenger that some of us are using was down for about 2 days. Nobody could receive messages and anything. And of course, that leads me personally to the thought that maybe it makes sense to reconsider Ghost Chat, maybe something else, essentially where the information could be hosted via the nodes of Ghost. The chat could be a great possibility, and that chat will be completely unkillable. And when I started searching online about the messenger being banned, I was surprised to see that Messenger is being banned everywhere. India, Indonesia, Pakistan, parts of Latin America. They're being banned consistently. The reasons for the bans are, and the growth of VPNs is through the roof. There are multiple excuses. I mean, I can only imagine what type of blocking exists in, odd zones such as, potential war zones. Say Israel, Palestine. I can only imagine how much of that stuff getting banned. And would be nice to have a completely, to give people what they deserve, meaning communication, right, via ghost chat. So lots of interesting developments that could take place. Now, last week there was some problem with the internet, like going between proxies and stuff. And I was demoing the bridge. So hopefully you guys played with it. I don't think you did though, but I hope that you did. How do I know that you probably didn't? There have not been that many bridges since last week, so highly encourage you guys to test it, to see the animation, and then essentially tell us how to improve it. But we published a bunch of articles already, and we need to go over them. And they are, some of them, pretty difficult to comprehend. So let me try to dive into it. So let's go to the Elasticity Premium, which we were supposed to cover last week as well. So it has been published a couple of weeks ago. So there's this interesting concept of risk premium. And the risk premium, those of you who took any finance classes in college, you should have gone over that theorem of CAPM, as they call it, capital asset pricing model. So essentially, the idea for that model is there's no additional gain without additional risk. So, for example, say in the US today, you can get about 4% on high yield savings account, maybe 3.7, 3.8, 3.9. If you go for treasuries, maybe a little bit higher. But if you say go for the stock market, which is up a lot, like it doubled since COVID, powered by all the inflation, all the increase in monetary supply of the USD. So you'll say, well, like in the stock market, I'm up 30% last year, and this year I think stock market is up like another 10 or 15%. So like you're up essentially 50% in 2 years. So like you're a genius. You must be a freaking genius, and especially if you have 401k, you are a double fucking genius because now you also do 401k. Some employers do matching for your 401k for every single contribution up to a certain limit, typically about 3 to 4% of your salary. So now you're up 8% of your salary, and that thing significantly went up 50%. You're a freaking genius. It's also tax advantageous, so you can trade out. And the CAPM says, no, you're not a genius. You just took massive risk. The stock market is significantly overpriced, for example, which is true. So it's a ticking time bomb. Like they're either going to keep printing money and keep raising prices, therefore keep increasing inflation, or the stock market has to come down because it's too freaking high. And all this AI revolution BS, like it's not going to help the market sustain itself. It's all bullshit. Yeah, it's a great tool, sure, but it's not going to save anything. So that's the risk that you're taking when you go in for the stocks. Now, while Bitcoin is up, what couple of years ago it was around 30,000. Now today it's 110. So it's like up 4x in 2 years. You must be a genius. You are an absolute fucking genius. No, you're not. You just took significant amount of risk. Based on what some people say, whether you believe this or not, but Bitcoin could drop down to zero potentially. So if you entered at 30 grand, let's assume about 2 years ago, you could have lost everything, all 100% of your investment. But it's up 4x, not because you're a genius, because you know the industry really well. No, you just took the fucking risk, took massive risk. Definitely, there was maybe a little bit of expertise, but I guarantee if I ask a general and normal, like if I ask an above average, not an average, above average Bitcoiner, I would say if I ask 95% of Bitcoiners out there why you are buying Bitcoin, they would be telling me the same bullshit answers, and I can absolutely kind of debate and prove them wrong. Of course, they will not agree to me being wrong because they are right. Why? Because they're the smart ones. They're the ones who capitalize on the upside. But in reality, it's just massive risk. Same applies for any ICO, any startup, etc. So every single thing is risk. So that's what this Kaplan was saying. They would say, hey, listen, check, like, chill, chill, chill. Like, here's a risk-free rate. The risk-free rate was essentially the rate that would be paid by the Treasury. Uh, Normally, it would be a 10-year Treasury of the United States of America, 10-year bond, and then anything above it, as far as the expected return, always has to go with the increase in risk. So the higher the risk of the asset, the higher the potential return. So that risk premium, this orange triangle here, is a risk premium, essentially kind of like a return that you need to get paid to compensate for risk. So that has been the model. Now, here's the thing. This model has been published, I think, in the 60s. So 1960s. So almost like 60 years ago. So at that point of time, the dollar was still around the standard, the gold standard. So it was a partial, like, I forgot the term, but it was not like a full proper gold standard before 1913. It was like this weird hybrid um, hybrid form of standard. And but still, there was a little bit of gold, at least associated with the dollar. So back then, 60 years ago, based on that theory, which by the way has been disproven a little bit, good morning, McNomad, has been disproven a couple of times already. The risk-free rate on the treasury was considered to be as good as gold because dollar was as good as gold. Yeah, there was inflation. In fact, inflation was through the roof even prior. Like the fact that it's a 2% inflation is a recent thing. It's really just, recently. Like in 1960s, 70s, 90s, 80s, 90s, prices, first of all, the economy went through multiple recessions, and the the inflation has been untapped, and interest rates went up sporadically as well. I think it was like up to 20% on the interest rate, so therefore inflation was within the same ballpark. But why that time is still kind of good time, at least for the U.S. economy, because there was massive growth, and massive growth was mostly taken from kind of engaging in bankrupting weaker countries. So we have the Southeast Asia, we have the whole Eastern Europe, Eastern European region with the Soviet Union. We have absolute, degradation of the Latin America. Like the reason why Latin America is so poor is because U.S. has been milking it for decades. And it's fine. It's called capitalism, right? So the strongest, kind of the fittest, the survival of the fittest. But the unprecedented growth coupled with what has been happening, uh, like inflation didn't matter much because prices would go up. Absolutely, why not? But the salaries would go up, the opportunities would go up, right? So, and everything was still affordable. So that's what we are dealing with the kind of the historical context around the CAPM. What changed? What changed is that U.S. dollar is slowly but surely uh, turning into a shitcoin. Okay, so uh, the inflation is like all the GDP growth, like lots of us don't believe that it's true anymore, right? Like there's like kind of is it describing this? Yeah. So like public trust in the government, right? For example, in 1960s, 70% of people trusted the government, and then the kind of this whole Vietnam War happened, and that significantly dropped down the trust. Then kind of went back up almost to 50%, and then again, right? So there was 2001, there was you know the 9/11, which actually uh, in 3 days, well, in 5 days is going to be kind of memorized all across America. Terrible event, and then um, the recession here of 2008, and then also here there was a dot-com crisis. By the way, there was massive hope here during Clinton era because there was a massive, uh, essentially hostile takeover of Soviet Union assets. So 1990s were like one of the most fruitful years for US and Europe. So since then, now today we're looking at roughly what 20-25% of public trust in the government. That's just what it is, based on Pew Research. That's just what it is, no matter what the party is, by the way, Democratic, Republican, or Independent, which never won. So it does not matter. That's where we stand. So, and the reason why that's the case is because the kind of the inflation, the official CPI is yellow, right? But throughout all these years, the kind of well, that's this, right? Then if I could go to to the shadow stats inflation. So official inflation, sorry, the official inflation CPI here is blue, right? Now the shadow stats inflation, which is kind of considered to be real, is white. You can see massive discrepancy. So for example, here for the blue, roughly 7%. At the same time, shadow stats would say 13%. Now this statistics, by the way, has not been taken from the official shadow stats. It was more like looking at the chart and trying to kind of figure out the right levels, but they're close enough. So shadow stats again, that's you can Google it up. Shadow stats. They publish the chart of official inflation versus what kind of how they measure inflation. And a couple of ways how, for example, CPI is being calculated, and Michael Saylor did a pretty good job explaining how that is. For example, let's assume you need a house back in the 50 years ago, and that house needs to be 1,000 square foot, right? So uh, okay, that's good. But back then you probably had a phone, right? So it was a stationary phone. Now a stationary phone would probably take, I don't know, half a foot, right? Or one square. Let's just for the sake of example, 1 square foot, right? Like that's how much space it took. Okay, cool. But today's phones are much smaller in case they're pocket phones, so you don't need special place in your house dedicated for the stationary phone. So what they would do on the CPI level, which is Bureau of Labor Statistics, they would say, okay, cool. So no longer do you need 1,000 square foot house. Now you need a 999 square foot house, right? And they would do the same thing. So like before, computers would be giant. Now today it's a laptop. Oh, you don't need a space for that. You don't need a separate desk. So down another 10 feet. So now it's just not it's how much 990, right? And so on. So they would shrink stuff that you need, and they would then account for like the average increase in prices, including real estate as well. For example, based on that kind of shrinking type of rules. And that applies to everything. So because technology is making things so much more efficient, you essentially need less of stuff. Um, what I would think they would do is, oh, like before you would need 2 kids and a wife. Okay, fine. But today, you don't need that anymore because everybody's single. Oh, so you don't need a 990 square foot house anymore. Divide that by 2. Now you just need 495. Right? So stuff like that. Oh, you don't have any kids anymore. Oh, so let's remove another 30% from your house. Now you just need 400 or whatever, 350 square foot per person. So like we shrunk from 1,000 square foot, like house to like a 350 square foot studio. And that's what they would do. They would say, okay, cool. So yeah, absolutely. The prices did appreciate, but our demand shrunk because technology evolved. So therefore we need less of stuff. So let's adjust for that too. And that's what they do with CPI. And Shadow Stats says, wait a second, chill the hell out. Let's actually calculate like apples, like let's not compare apples to oranges. Let's compare apples to apples. So we feel that, right? Like we as average people feel that. And We're like, okay, something's not right, and they keep telling us everything is fine, economy is fine, and our trust just drops down. How is that relevant to CAPM? We started the financial aspect. Well, it's relevant to CAPM because no longer does risk-free rate mean a risk-free rate. Risk-free means there's no risk. No longer do we think that US will not like default. Like, okay, let's assume US will not officially default. Fine, but US will just print shit ton of money. The money printer will go borrow like even more. Like what we've seen with COVID is nothing. Why? Because the great tsunami is coming, right? Like the yeah, kind of the generation of what 60, 70 year, 80-year-old guys and girls retiring, and they have massive 401ks, and they would be selling this fucking thing, right? Because the medical expenses also grew, right? So there's not much they can kind of inherit to their children. So they'll be selling this shit. And when they sell, like they bought one stock, and today this stock has so much more worth, kind of weight on the market because it went up like whatever 20x. So we'll see that great tsunami, and then in order for the recession not to happen, again, the U.S. will just have to print even more money, right? So they either have to print money, which is like even less trust, or they have to default, which is also less trust. Both ways are bad. Which option? Whatever, right? Whichever president decides to take full responsibility. We thought it's going to be this president, and it doesn't seem to be the case, right? So because politics is politics, whatever. So since there is no, so sorry, let me go back here. So since we cannot trust the risk-free rate of the 10-year treasury anymore, maybe it makes sense to start looking into the elasticity. So like essentially have the same approach, but like start measuring currencies based on their elasticity, right? And the reason why such theory has not been uh, offered prior, has not been considered, because why would they do that? Like dollar is as good as gold. Currency is good. Currency, yeah, depreciates by 2% per annum, whatever. Okay, fine, no problem. We can always buy the treasury, and the treasury is good. US is very strong. US is the best economy in the world. That has been the premise 60 years ago. Today, it's not the case anymore. Because today it's not the case, we have to start doubting the risk-freeness of that rate. So that rate potentially is not risk-free. It's a rate. So it's also super risky because you'll be losing your purchasing power. You're either going to be not kind of either inflation is going to outpace this rate, or kind of the US will just default and not going to pay you. Because when US defaults means that US will stop making any payments, any coupon payments on your treasuries. So the risk-free rate disappears. So that becomes risky. So that's the idea for the elasticity premium. And again, the reason why I think nobody kind of looked into it, maybe they did, maybe if you know of an economic theory about it, please tell me. Otherwise, I would assume that this theory has been kind of created by the Ghost team, or the Ghost community. Let's put it this way. So that's a native thing. So what does elasticity premium say? So to do like proper research, more data needs to be found, and so sometimes in scientific circles, you either prove a theory, or somebody like made a theory, right? Like kind of proposed a theory, and then somebody else years later would prove it, right? And has been the case with a bunch of things. Like for example, even today, we have 7 millennial problems, math problems. If you solve each one of them, you'll get $1 million. And so for one or two problems got solved recently, but those are millennium problems, meaning somebody like famous mathematicians from the past didn't know how to prove it, but intuitively felt that that's going to be true or wrong or not or false. So they would propose a theory, and then today's mathematicians, their goal is to try to solve it. And same thing happened with a bunch of other disciplines. So maybe somebody would collect the data and either prove this theory or disprove it. But the idea here is the money elasticity, like theoretically, there has to be a premium the more elastic the currency is. So if it's more elastic, let's assume, such as Turkish lira or Argentinian peso, then kind of the elasticity premium, right? Like kind of like the 45%, 30%. It means that this currency is extremely elastic. They just print the shit out of it. Now, of course, kind of we say, duh, it's true, but not necessarily. Because, for example, what Keynesians are saying about the US economy, they're saying, oh, we're printing lots of money, but our economy is also growing. Our economy is also increasing. So our GDP is growing. So inflation is actually not as not as wide as the increase in monetary supply, which is true or not, that's what they say, right? That's kind of the excuse. And now the Austrians would say, no, 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 we don't care about the GDP increase. We care about monetary freaking supply. If it increases, that's the inflation. Let's measure it like that. Okay. So, different schools of thought, different kind of different conclusions, but kind of can we attest that the say Turkish GDP kind of grew faster or slower than it really did compared to how much money they printed, or Argentinian economy, right? Now, conversely, we have some kind of lower elastic, so more inelastic money, and that's all money, such as, for example, Singaporean dollar, right? The inflation is much, much lower compared to the US, right? They're not printing as much. Or Swiss franc. Swiss franc is known to be backed by 25% of gold, if I'm not mistaken. So it's a lot more stable than US. So USD. So if you look at, say, USD versus Swiss franc last year, USD lost about 6% of purchasing power compared to Swiss franc. Why? Well, because Swiss franc, again, 25% backed by gold, and gold went up about 30%. So when you do 30% divided by 4, you get 7.5% appreciation in assets back in Swiss franc, and here you have it, right? So, and USD lost everything, right? So now, had Swiss franc been 100% backed by gold, then Swiss franc would have gained 30% of value compared to the USD, right? So again, that's what we have, right? So the idea here is kind of the theory that I just don't have the stats, and I could probably collect it, but I would have to spend a lot of time just for that theory, and I have to cover so many other things. So we'll just put that as a theory for now. If you guys would like to take a stab at it, please let me know. But exactly, like essentially, the more inelastic the asset is, the lower premium it must offer for that elasticity, for that inelasticity, therefore. And conversely, the more elastic the currency is, meaning the more supply it could be printed out of thin air without any correspondence to the purchasing power, the higher the elasticity premium must be offered via bonds. For example, Swiss franc does not need to offer any high yield on their treasuries or high yield savings account. Like high yield savings account for Switzerland could be 0% because it is the strongest freaking currency in the world based on this theory. Conversely, Turkey, for example, go to the bank, Turkey would offer you, check it out, would offer you up to 45% APY. Of course, in their native currency, in Turkish lira. Why that's the case? Well, because the currency is a piece of shit. It's freaking dropping. It's weak. You go to Argentinian banks, and because the currency is so freaking volatile, inflation is so high, you would have to also see if they offer, say, around 30% of interest rate, and they probably do. Yeah, because those are the Federal Reserve rates, right? Now, the thing that is not calculated in this theorem is the elasticity coefficient itself. Right? So those are real numbers here. Those are just interest rates. But then the question is, what is the elasticity coefficient? Now, for the elasticity coefficient, kind of the idea is that elasticity coefficient, elasticity premium will be something like epsilon times gamma, where the epsilon is the elasticity of the currency itself, which we need to calculate somehow. And then gamma, standing for goes, that's why it's gamma, coefficient reflecting macroeconomic factors such as debt levels, inflation, and monetary expansion. So, like, expected elasticity premium, therefore, is going to be that. So, expected elasticity premium, therefore, need to be compared to the interest rate. Right? So, we have interest rate, so we do have a benchmark. Elasticity can be calculated, and then gamma is going to be some type of variable comprised of additional variables potentially that would essentially kind of make that equation work out. And of course, gamma will be depending on certain macro and microeconomic factors within that specific nation. Right? So that's kind of the idea. Now, why are we even talking about this? Like, why the freak are we talking about this? Why, like, we're talking about ghost? Like, why? The reason being is this. The inelastic assets that we described in previous chapters include gold and Bitcoin. And everybody says, Austrians, Keynesians, not really, MMT, not really, but everybody who's say, well, gold is good money. And there's also big realization that Bitcoin is also better money. Yeah, today is very volatile. Well, it's not money, it's volatile. Well, yes, because the GDP of Bitcoin today is $2 trillion. How about you increase it to 20 trillion? and we will see about the volatility. By the way, gold is at 23 trillion market cap today, and it went up about 30%. I was checking out the statistic from before COVID, and gold doubled since COVID as well. Very similar to the stock market. So like stock market is almost flat adjusted for gold. So that's a pity because inflation is that. So inflation is like cumulative inflation has been 100% since COVID. That's kind of based on what gold is telling us, based on what the public perceives, which is so prices doubled in 5 years. Congratulations, COVID resolution was fucking great throughout the world. I'm absolutely amazing. We got everything as humans. We fucking got our prices lower. We got more freedom. We got kind of a lot of free speech. It's all sarcastic, right? After COVID, we lost everything. We lost on prices, we lost our freedom, everything. Don't forget how they locked us up for what 2 years almost. We couldn't do anything. So across the world. So the idea based on this theorem is that gold and Bitcoin, since they are better money and since they are inelastic, they should not be offering any elasticity premium. That is kind of the whole point. The whole point is, okay, Bitcoin is inelastic by itself. So, like, while dollar should offer us 4% APY, and then Turkish lira has to offer us 45% APY, and Argentinian peso has to offer us 30% APY. Gold does not have to offer us any APY. Bitcoin does not have to offer us any APY. But wait a second, it goes up in price. No, it goes up in price. Absolutely. Bitcoin increases, gold increases, sure. I'm not talking about that APY. I'm talking about the APY of increasing in quantity. For example, dollar, right? So you put $100 in the bank, 4% APY. At the year end, you're going to have $100, the original, plus another 4%. So another $4. So your quantity is going to increase. Now you don't have $100 anymore, you have $104. Same thing with Turkish lira, right? So you put 100 Turkish lira in a bank. At the end of the year, you're gonna have 145 Turkish lira. So the quantity increased. Why? Because they have to compensate for the currencies being elastic. When you go to store your gold bar somewhere, say in a safe deposit box or whatever, or in your house, or some other vaults, you do not expect to get any premium. So you put your piece of gold, ounce of gold, and then at the year end, you still have an ounce of gold. So it by itself preserves purchasing power. Same thing with Bitcoin. You have one Bitcoin in your wallet, and then at the end of the year, the price may increase or decrease. Doesn't matter. You still have one Bitcoin. Why? It's good because that's inelastic currency. So inelastic currencies do not have to pay a premium. And essentially, that is the dichotomy that we lived in. So that's the dichotomy that we lived in for, I think, almost 500 years. I need to know exactly, but I need to find out exactly when the gold standard really took off. Because, for example, the Isaac Newton, he was paid some amounts of money to get a position, to be hired, in order to help England move out from the silver standard and into gold standard, famously. So when was that? 400 years ago, 500 years ago. So it would be nice to know exactly when nations across the board, not just one nation, nations across the board, started switching towards different standards. Because let's say Spanish found lots of silver in Argentina, right? Argentina, it's Argentum. Argentum, if I'm saying that correctly, Argentum, that's a chemical standing for silver, right? So that's why it's Argentina, because they found shit on the silver, and they were trading that silver for beats and stuff. So with the with the locals, and then they killed them. Also traumatic stuff. So so we lived in this dichotomy of like gold and silver money, which is say good for 500 years. Let's find out how much time it actually was good for. Say for now, let's just say 500 years for this call. And then kind of for the last maybe 100 years, like since 1913, especially since 1960s, it's been the fiat standard. So they say that's the only two types of money we have, right? So that's kind of the thing. They say, hey, listen, like Keynesian saying, fiat money is the better money. It's fresh. It's new stuff. It's just like, it's since 1960s really. Well, Keynes kind of, think like beginning of 19th, beginning of 20th century, so maybe longer, maybe for 100 years. So let's say fiat is fresh money because it's for 100 years, so it's new technology. It has to be better. And Austrians say, no, we are more conservative. Let's go for gold. Gold is better money. Bitcoin is better money because they're inelastic, but that existed only for 500 years. Question is, the humanity, the civilization exists for 10,000 years. So what did exist before that? Right? So okay, last 100 years it's fiat. I get it. Okay, fine. Last 500 years it's gold standard, silver, coin, like bronze. Okay, what about last 10,000 years? What standard did we have? And nobody talks about it. Like nobody freaking talks about it. And that's why the dichotomy for us is, well, either fiat or reserve currencies. So this money elasticity premium is for fiat currencies on the left, and reserve currencies, which is gold and Bitcoin and silver. Silver needs to be added here too, on the right. That's it. But there's a third option, and the third option will be covered right now. Right? So because I wanted to cover it for such a long time, I already like name dropped, sneak peeked, whatever. So please read this article in more detail about elasticity premium. Because elasticity premium, essentially, risk premium, that's for the assets. But since assets were benchmarked against the treasury and treasury lost all the trust, we have to go back and reevaluate all the currencies. And we evaluate them based on the elasticity premium. And we find out that it's really just kind of the option is to either have premium as far as quantity for elasticity or not have a premium for inelasticity. But there is a way how to be both inelastic and also have a premium. But they don't tell us about that. So we call this, so read this article one more time, please, by yourself, and ask questions. So let's go through this article, which is Vita Money. That's what Vita Money is. So I name dropped before, I already mentioned that before. But the idea for Vita Money is we can self-replicate the scarcity. So it can be both inelastic and also self-replicable. So if you're going to put it, say, on this chart, we have fiat right there. We have reserve currencies right there, right? Like elasticity premium is 0. Vita Money would be here. It would be both inelastic, but it would also be paying you premium. And that's an innovation. So our dot, which is not visible here, like we'll have to regraph this chart and put like essentially kind of, we have to be, we have to prove if Ghost is Vita Money or not. So that's, we're going to go through kind of all the proofs, all the explanations, all the facts. But if Ghost is Vita Money, then Ghost will be somewhere here. So it will be both inelastic, means it's scarce to some extent, and at the same time, it also pays you a premium. And that is the third type of money that nobody freaking talks about. Even Vita Money, we had to coin the term. That's the term coined by the Ghost community. Okay? Like, that's the freaking cool stuff about it. All right, so kind of let's go step by step. I don't want to rush through this. If you're running out of time, I would like to revisit this one more time next week. Okay, but let's start the introduction today. So we say that yes, inelastic assets, gold is great. It's inelastic, it's amazing. Inelastic again means what? Means that the price can increase, but we cannot physically increase the supply. Right? Like no matter like for dollars, for example, it's easy. Like the price increased or whatever, we can easily print more dollars. Like it costs us nothing. Paper is available. We can print a lot. Not backed by anything, so we don't care. Gold is scarce, so good luck extracting more gold. It's very difficult. We discussed it before in one of the previous articles, maybe a month ago, where we said that gold is actually inelastic. So it looked elastic because a lot of it has been extracted in 20th century, but overall it's very, very inelastic. Like there's about maybe 20% remaining in the ground, and that's it. Of course, there are new mines found here and there, but when you look at the quantities of these mines, it's like not much. The biggest one found in Uganda actually said to have double the supply of gold, but even that. So let's assume it's even doubled. So what? Like it's doubled. Like it will be extracted God knows when. You probably like need massive equipment for and technology for that. So it's probably going to take another 21st century to extract and another half, right, of newly supplied gold from the ground. I mean, by that time, by that time, the quantity of USD will increase by 1000x. Okay, so gold is still inelastic, right? So you cannot like increase the supply based on your wish. But here's the situation, right? So we say gold is scarce, right? Its virtue is the fact that it's limited. Okay, cool. But again, it does not give you any like quantity upside. And would it be nice to have that quantity upside? And that's what Vita is, right? So Vita is, it gives you quantity upside at the same time it's still inelastic. That sounds like freaking paradoxical. How does it even work? So like you can print it. So like kind of the asset itself kind of like self-reproduces fast, but at the same time it's also inelastic. Doesn't work. Like if it's reproducing, it has to be elastic, and that's exactly kind of not the case. It is reproducing and it's also inelastic. That's the genius. So let's kind of dive into a little bit of how I even thought about that. Kind of the name and also the analogy. So I was thinking that like and how the name even came up. Like that's a pretty interesting story. So I was thinking. So I know one of the whales mentioned a money tree analogy. I had a golden goose analogy in my head. I'm like, oh, so essentially we're saying that Vita money is like a golden goose. So you have a goose that breeds like golden eggs, right? Because that's kind of the way how gold can produce itself, right? Like if gold can have babies, which is Vita money, then it's like a golden goose. And then I started thinking, like, wait a second. So, but for the golden goose to really reproduce, the golden goose must be reproducing all the other golden geese, right? But then other golden geese also have to be reproducing more golden geese. So there's no gold there. I'm like, wait a second. So that whole story about the golden goose, I'm not sure if you know the fairy tale. Let me quickly kind of tell everybody. So this dude, farmer, bought a golden goose by accident, and instead of geese, the golden goose, kind of was breeding gold, like golden eggs. So they were like, okay, that's cool. So they started selling it, right? So obviously, they started selling golden eggs, became rich, and then because golden eggs have to be produced on a schedule, because golden eggs, even in that fairy tale, were inelastic. The goose could not freaking produce it on a wish. They had to wait probably a year, or whatever, like whatever the gestation period is, like maybe half a year for the egg to appear. So the farmer and his wife became impatient, and they killed the goose because they thought that the eggs are inside of him, and of course they found nothing. And the story is like they screwed up. Like that's a fairy tale. Okay, thank you, kids. Right? So that's what happened. But from Vita money and Golden Goose money, because I think that fairy tale was actually about the golden standard. If you think about this, right? Because back then, when that fairy tale has been written, I'm pretty sure it has been by the Hens. Is it Hens brothers or whatever? From Germany, from Prussia, whatever, from Bavaria maybe. So at that point of time, I think maybe the nation was actually switching from Vita standard to golden standard. So the idea was, which one is better, Vita, which is in that case goose, because the kind of geese can reproduce. It's Vita money. They cannot reproduce on a wish. But which one is better? To have a golden goose producing golden eggs, or to have a golden goose, or to have a goose producing just other geese, like normal organic geese. Which one is better? And I started to realize that it's actually better just to have a goose. And here's why. In the short term, of course, it's better to have a golden goose. Why? I have like gold can be sold, right? So I'm producing a golden egg. Okay, cool. I can go on to the market and sell it. Great. But what happens if I overproduce the golden eggs? What's going to happen to gold? Gold will no longer be inelastic, right? It's no longer going to be scarce. Gold will become infinite supply. So you actually inflate the quantity of gold on the market. What's going to happen to its value? Its value is going to collapse. So in the short term, before you overinflated the market, golden goose is probably better. If you take the long term of say 1,000 years, it's way better just to have a golden goose. Just to have a normal goose. Because in 1,000 years, a normal goose would produce you probably, I don't know how much, like we need to look at this, like based on the Fibonacci levels, you'll probably be looking at, I don't know, 10,000 geese, maybe more. And each one of them has significant value. You'll say, but wait a second, but 1,000 geese, you also own an overinflated supply. Well, we did overinflate supply, but here's the thing. It can only be overinflated if people will be consuming it. So if population increased, the value got retained. So the idea of Vita money is Vita money, in a way, grows with revenue. And revenue grows with the population. So if there's no population, if population of a given country, for example, is being shrunk because of the war or disease or whatever, of course, if you overproduce the golden, sorry, just kind of cattle, right, or whatever, livestock, if you overproduce it, yes, you will lose a lot because there's nobody to consume it. So the value of each of each cow, of each sheep, of each goose will be dropping. But you're not an idiot. You're a farmer. You see the supply. You're gonna, it's very inelastic. You understand what's happening. So you grow it based on the increase in demand. So you essentially grow with the revenue. So you grow with the economy. That's what Vita money is. But again, you cannot tell the goose to like reproduce on a wish. You cannot tell crop to grow faster. Now they're trying to do this. We're going to discuss it in maybe today or next week. Yeah, like with all the hormones and pesticides, absolutely can try to facilitate growth faster. Sure, but it's not the same organic item anymore. It's actually worse, scientifically proven. We're talking about pure self-replication. How we talk about pure Web3? We talk about pure self-replication. The properties must remain. Otherwise, it's not organic, meaning, like, forget about the word organic. Unless the properties are fully kind of inherited from the father, right, and to the offspring, from the mother and to the offspring, it does not count to be Vita. So Vita specifically has to be retaining all the properties. Right? So if it's a cow, it has to be an organic cow, just like it was 1,000 years ago. Green Brothers, thank you. Green Brothers. Yes. Thank you. Exactly. Somebody mentioned that. So that kind of has been the name. Now the question is like, why Vita money? Because in fact, as I mentioned to you guys, I had another kind of asset in mind, and I didn't even like kind of the origin of that. It didn't strike me that natural money from the word nature were the first Vita money. I was actually, as far as Vita money, I was actually thinking about something else, like this asset that we're going to be uncovering probably within a month, not earlier, because there's some other articles pumping up right now. But then the more I thought about this, golden goose analogy, the more like, oh, wait a second. It actually was the first money. Vita was the first money. And there's lots of proof about that. And every single economist confirms that it was the first money. Yes, it lost to reserve currencies, but it was the first money because it grew with inflation and it was actually consumable. And then I'm like, oh, what should we call? What should be the name? And the Vita kind of just popped out by itself. I was thinking like, I imagine kind of leaves. I imagine like a tree. So another whale was talking about money tree. I was just thinking it was just normal tree. I was like, oh, and like the green, I'm like, oh, it's Vita. And what's Vita? Vita is life in Latin, and fiat is we have it somewhere else. Let it be, because meaning let it be, meaning no back end, it's fine. And obviously reserve is reserve, right? Also from Latin, meaning to have something back in it. So some people say Old French, some people say Latin. They're close anyway. Same Roman language. So that's kind of the origin. So the origin was actually like, I didn't think about sheep and cattle and livestock prior. I was actually thinking about the biggest asset on the planet, which is Vita asset. And then it struck me. I'm like, oh, wait. It's like, it has so much sense now. And that was like a breakthrough. So purely coincidental. And it's so coincidental. And that's how I know that we're moving in the right direction overall with the Ghost Project. Because lots of little details, lots of little coincidences here and there. And overall, like a coincidence here, a coincidence there, and like 10 coincidences in a row. And now this is a genius freaking idea. Lots of those coincidences have been completely random and lucky. Like we just got lucky with this. So we need to praise to gods and to John McAfee for giving us this inspiration, insight. And by the way, I'm not being sarcastic at all, because this stuff is it was like some type of like this knowledge I felt when this stuff when the Vita whole angle came about. I felt like a very like I wouldn't say like angel type of feeling, but very close to that. Like it was like you just like I was feeling insightful, not for a second or for a day. I felt insightful for a couple of weeks. It was that. I couldn't sleep anymore. I had to write stuff out, and that was because I thought this series would only be like 4 articles. That's it. the ghost monetary paradigm. The reason why it's more is because I finally have insights of what to write. Thanks to the John McAfee, thanks to whoever is giving us these insights, thanks to the team, and thank you for you guys for being so supportive and for finding interest in this thing. So again, Vita money, that's the new term. And what's interesting is Vita means life and ghost is afterlife. And it's interesting that ghost resurrects money because fiat is dead money. It's dead. It's paper, like actual paper, right? It's from a dead tree. Now these ones, the gold is minerals. It's dead minerals. There's no soul there. Vita is life money, actual life, crops, um, livestock, right? Some other assets too. It's like lots of life, and it had to be the afterlife. It had to be the ghost that would introduce the life money. So we resurrect money, returning because the money is supposed to be life. Okay. Any questions, please? Any feedback would be highly appreciated. But that's a real story what happened. So that some people say, oh, I thought about this, Google always wanted to create all the products like Gmail and everything. No, it was all lucky coincidences. It was step by step. Same thing here. I just wanted to give pure truth about how this whole kind of the origins of how it all happened, so we could appreciate the spiritual stuff above us, if it exists. Okay. So preservation versus multiplication, right? So the whole point about reserve, so fiat is bad money, we know that, but let's try to compare ourselves to reserve currencies. So preservation, so reserve currencies just preserve purchasing power, but we need to multiply it as well. We need to multiply how much we have it. And that multiplication will be in line with revenue, right? Because revenue is purely in line with the population growth. Now think about, let's take 2 steps forward, right? About ghost. The idea is that ghost is going to be minted more of proportional to bridging revenue, which is bridging revenue. The key word there is revenue, right? Of course, we have to prove that ghost is Vita and ghost is the only Vita. We'll prove that. We have to go through a bunch of other protocols and prove that those protocols are not Vita. And actually, not even reserve currencies. Lots of them are actually elastic in nature. But the idea for Vita is Vita can absolutely grow with revenue. Therefore, we don't need to either be like static type of treasury with gold, with precious metals, or we don't have to like have a Federal Reserve who would be controlling the supply, right? Why do they control the supply? They control the supply in Federal Reserve and all the other central banks because fiat currency is not in any way tied to revenue, to GDP. So they're trying to tie it. But Vita money ties it itself. So if you think about it, the reason why Vita money is the money of Web3 is Ghost is a chain connecting all blockchains together, disrupting centralized exchanges. So we are the blood vessels of the Web3 industry. So if Web3 industry is alive, there has to be bridging. So therefore, Vita money as Ghost is representing the revenue, right? The aliveness of the Web3 industry. Does that make sense? Right? So and nobody has it. That's the whole point. Like we are the first, not only we're the first with this kind of the technology on the decentralized bridging, fine, but we are the first to properly to put a proper framework of Vita money around it. And that's what kind of people wanted originally. It's in our DNA to have Vita money. That's kind of when we're going to go to that asset that I'm, keep sneak peeking at you guys without revealing. That asset is as well resembling Vita. And that's why we have all this staking in the world. That's why we love staking. We want the APYs all the time. What's the APY on this investment? What's the APY on that investment? Because it's in our DNA to have a fucking upside. Because when we have 1 sheep, we want 2 sheep tomorrow. Right? That's why we so eagerly want the staking. But the staking needs to be backed. So kind of how fiat currencies abuse staking, they give you staking through treasuries, sure, but that staking is not backed by anything. They say it's backed by the economy. Okay, it's not fucking backed by any economy. Any currency can default. So what, all of a sudden the economy doesn't have any GDP? No, it's just not backed by anything. right? Same thing applies um, say dividend stocks. Oh, we want staking. Yeah, but dividend stocks, if you guys know about dividend stocks, whenever they pay you dividend, the price of the stock drops by that dividend. So stocks are not self-multiplying because the price, because the dividend really takes out from the price. But we still want staking. So then go like all these protocols like Solana and Cardano, they're all for staking. We want staking, Tron, staking, APY, staking, APY. Why? Because it's now DNA. But if Vita money, proper Vita money, introduces staking, that staking has to be inelastic in nature, meaning it has to be backed. And so far, Ghost is the only project that has it. And of course, we'll prove it specifically in other articles. Now, Bitcoin, great, but Bitcoin is a reserve currency, does not offer any APY. Yes, APY in terms of price, but not in terms of quantity. Okay? So Mr. Adike says it's becoming more and more clear. Appreciate your support. Ask questions, guys. So we have 5 minutes. I would just like to start a little bit on the origins, and then we have to, I do not want to rush through this article. This article is super important, massively important. In fact, almost every single article after this one is immensely important. Please read this in more detail. But if you're going to go through kind of the actual, history, so ancient Mesopotamia, clay tokens, the first clay token found, described by some scholars as the world's first money ever, was sheep as standard value. It actually has sheep, like a picture of a sheep on money. Obviously, that's how archaeologists know that's exactly what it meant. One token was equivalent to one sheep. The first money in Mesopotamia. I think that civilization created created the concept of numbers and stuff. Then, of course, here we have also Indo-European livestock, pecunia. I'm not sure if I'm saying it correctly, but from Latin, pecunia, money. So pecunia in Latin, which is livestock, is money. Yeah. Okay. Now, of course, recently, so we have parts of Africa, we have parts of Eurasia, so say Mongolia. The bright wealth in many countries still measured as far as livestock. How many sheep you gonna give me, right? How many cows you gonna give me? How many horses you gonna give me? Bright wealth and other types of payments. Even to this day, it's all Vita money, right? Now you say, well, because they just couldn't create gold before. No, thing is this: how if I have a cow that I could eat, I could milk. This cow can give me more cows. How the hell would you force me to trade my cow for a piece of yellow metal? How the hell would you even persuade me? In what crazy world does this trade make sense? And this trade did not make any sense. Again, if gold existed, say gold standard is only kind of more or less popularized for the last 500 years. For the previous 9,500 years, it was Vita money. Because nobody would be persuaded to have a fucking, piece of gold as money. It's nonsensical. Gold, of course, became more popular when civilizations grew, right? So, and international trade became a thing. So yes, a kind of the population would have to withdraw Vita in exchange for gold just because you could port gold. And then governments started taking control over it and started taking advantage of it by printing gold and money and then diluting that gold, etc., etc., etc. Okay, so let's pause here, right? Because there's also this whole kind of chapter on seed-based seed, so not just livestock-based currency, but seed-based currency as well in China and Egypt, and etc., from wheat and grain, etc. So let's pause here. Ask questions around this stuff. Is super exciting. We're working on more and more stuff. Yeah, it will be revealed soon. So please attend these calls. Very helpful. All right, gentlemen and ladies, talk to you guys next week.